Hello, thank you for joining us. Today is Legacy Private Trust Company's Market Update Call, February 2022. My name is PJ Schaefer, Vice President, Trust Investment Officer, and joining me virtually is Connor O'Brien, Trust Investment Officer. With the start to 2022, what we wanted to do is put together a call and talk about four different things. First, we want to talk about 2021, and really it was a dream year. We'll give a little bit of an update on the caseloads of the Omicron variant. We'll talk about inflation, the Federal Reserve, as well as interest rates. And then, of course, we'll start to that volatile start in 2022. So really looking back last year, I said it was a dream year, and it's actually very true. If you look at the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite, well, we saw returns of 26.89% for the S&P 500, 18.7% for the Dow Jones Industrial Average, and the NASDAQ Composite was up about 23.4%. Really terrific year. In fact, the S&P 500, en route to that 26.89% return, recorded the second most ever all-time highs, 70. 70 times the S&P 500 hit all-time highs. The one thing we didn't see really last year was volatility. In fact, the largest peak to trough drawdown we saw last year in the S&P 500 was only 5.2%. It did not take long for 2022 to outpace that. Now, if we move on to the next slide, when we look at COVID-19, because what would be a market update call unless we talked about COVID-19, specifically the Omicron variant? What we can see, and this is a chart by the CDC, the blue lines are just the daily caseloads that have been reported. The red line, the line that I'm going to focus on, is the 7-day moving average. And if we look on the right-hand side, we've seen that 7-day moving average peak. January 13th, we were reporting over 800,000 cases of Omicron variant a day for a 7-day period. Less than 2 weeks later, that number is below 650,000. So this is really important. We've seen cases peak, but it's really important for the labor participation rate. As we've had individuals sitting on the sideline being a little bit concerned moving into the workforce, well, as those cases have turned over, we're going to see more people involved in the workforce, which is really going to help with wage inflation. Now, the other type of inflation is the U.S. Consumer Price Index, or CPI. This is really important. And in fact, if you look at this chart, this is a year-over-year CPI month by month. So the blue bar all the way on the right-hand side is December's year-over-year CPI at 7.2%. It's the highest rate in 40 years. Now, what this chart does is it looks at December inflation rate and it looks at where we were in December of last year. Now, there's an important concept here. It's called the base effect. So as you look at 2021 inflation and you saw it continue to increase, well, the base number there is 2020, the year before. So what happened in 2020? Well, we had a global pandemic, we had a recession, there was zero inflation. So if we saw any type of inflation in 2021, which we did, it's only going to be exacerbated by the low base effect of 2020. The important concept here is as we're into 2022, we're having a tougher comparable when we look at where inflation was at this point last year. Now, the one thing that we're going to do to fight this inflation, which we think will come down because of those tough comparables, is what the Federal Reserve is going to do. The Federal Reserve, the way they fight inflation is by increasing the federal funds rate. And in fact, if we look at what's going to happen through the rest of this year, Bloomberg has actually gone out and they can look at how many rate hikes are priced into the market or what the market is expecting. Well, the market right now is expecting 5 25 basis point rate hikes throughout the rest of this year. The first of those rate hikes is going to be in mid-March. Now, the important thing, I just want to take a minute to comment on March. There is some belief that we might get a 50 basis point interest rate hike in March. That is not our view. In fact, over the last couple of weeks, we've heard a lot of Federal Reserve members come out and kind of dispel that notion. So we don't think there's going to be a 50 basis point interest rate hike. In fact, the market only thinks there's a less than 1 in 5 chance that's going to happen. So we do think there's going to be a 25 basis point hike. And 4 more rate hikes are priced in throughout the rest of this year. In fact, James Bullard, who is the most hawkish member of the Federal Reserve, he has come out, and not only did he kind of dispel the notion of the 50 basis point rate hike, but he also said that he's expecting 5 interest rate hikes through the rest of this year. Patrick Harker, another member of the Federal Reserve out of Philadelphia, he's thinking that number might be closer to 4. So only time will tell with specifically how many rate hikes we see through the rest of this year. But one thing is certain is the market is already expecting 5, and we'll talk a little bit about how this year started out, and I'll let Connor cover that.
Thank you, PJ. So as PJ noted, inflation is at 40-year highs, and therefore the Fed has decided that loose monetary policy is obviously no longer warranted at this point. So they've telegraphed that they will slowly begin to raise interest rates from 0 in March of this year. And this is a big change of pace from most of last year, when the Fed had generally indicated that they wouldn't look to raise rates until 2023 or potentially later. Now, thanks to clogged up supply chains, a shortage in semiconductors, rising energy prices, so on and so forth, the Fed realized that inflation isn't going away quite as quickly as everyone might have thought originally. So they really changed course, specifically in the December FOMC meeting, when they pivoted and announced that monetary policy would actually begin to tighten, and we would most likely get a liftoff in rates starting here in 2022. So what's happened? Over the last few months, the bond market has begun to price this in. You can see beginning in late October and early November, there has been a fairly rapid rise in interest rates that, for all intents and purposes, had pretty much been at 0 since the beginning of COVID. What you see here are the rates on US Treasuries from 6 months all the way out to 5 years. Now, it's important to note that this increase in interest rates really started back in February of 2021. You can see that initial bump there in rates early last year, and I want you to keep that in mind because we'll address that in the next slide. So this tightening in monetary policy and subsequent rapid rise in interest rates has been sort of the biggest blame for the rocky start to 2022 so far. The S&P 500 corrected 10% to start the year. It's bounced back a bit here in the last week or so. The Dow is down a little bit less than that due to its outsized exposure to energy and financials, which have done well. The NASDAQ and small caps, which traditionally benefit from lower interest rates, have been hit a bit harder, down between 8 to 10% in January. Now, it's important to note that this market weakness is not a new phenomenon. Interest rates really have been driving the bus here since February of last year. So going all the way back to when COVID started in the spring of 2020, interest rates fell off a cliff and pretty much sat at 0 for almost a full year. And in that 0 interest rate environment, you saw high growth tech, you saw IPOs, you saw crypto, you saw small caps, all of these really, really long duration assets and indices absolutely rip. And you see those returns there in green in the chart on the right. Now, in February of 2021, the stock and bond markets looked at this and came to a realization that growth coming out of COVID was going to be much quicker than anyone anticipated. And we saw that in the last slide. Rates began a slow liftoff starting in February of 2021. And those assets that benefited from the 0 interest rate environment really began to crack at the beginning of last year. And since the spring of 2021, those assets that I just mentioned have had this long, slow downward burn, as you can see on the chart on the right in red. And that's really all just come to a head here in January of 2022, as that rise in interest rates went from really only affecting a small sector of the market or a small subset of the market to really putting a damper on pretty much the entire equity market. Now, it's important to keep in mind that while not fun, what's happened in the equity markets so far this year is entirely normal. A year like last year, where the market goes up 30%, sets 70 new all-time highs, has a max drawdown of 5%, as PJ all noted, that is really an aberration. That should not happen. 5, 10, 20% corrections can and do happen much more often than the market has led us to believe here in the last decade or so. 10% corrections should be expected at least once a year. And going back to 1928, the average intra-year drawdown for the S&P 500 is actually over 14%. The drawdown hit 10% in January. So even by historical standards, we were still 4% away from even approaching an average drawdown. So our point is that all of this volatility, it's all okay. There is a reason that stocks average 9% a year over the long run and bonds average 3% a year. These drawdowns are that reason. It's not a reason to panic. It's not a reason to bail on equities. And if anything, it should be expected. So if this drawdown made you nervous, it might be a good idea to talk to your administrator or portfolio manager just to double check on whether or not you might need to de-risk your portfolio to a level of equities that you might be more comfortable with. Now, the reason we can sit in front of you today and tell you that this sell-off is interest rate driven and not due to some sort of systemic fundamental weakness in the economy or in the markets is because when you look at credit spreads, they're showing no signs of distress. This chart shows the spread between high yield bonds and US Treasuries. So in periods of distress, those spreads get really wide. And that happens because people sell high yield risky securities and buy safe haven US Treasuries. It's sometimes called a flight to quality or a flight to safety. Where we sit today, there are no signs of systemic risk or weakness, and credit spreads continue to remain historically tight. Now, that hasn't stopped investors from becoming very, very bearish. In fact, market sentiment is at the most bearish level since 2013. And yes, that includes the bottom in March of 2020 during COVID. The bottom chart you see here is just the S&P 500 going back to 2015. The top chart is the results of what's the most popular investor sentiment survey called the AAII survey. And it takes the percent of investors that are bullish minus the percent of investors that are bearish. And as you can see, investors are very, very bearish. And if we look back over the last 7 years, those times of peak bearishness were usually very, very good buy the dip opportunities. It happened in early 2016. It happened in late 2018. It obviously happened in the spring of 2020. And in hindsight, all of those times, if investors bought equities, they were handsomely rewarded. And at this point, we see no reason to bet against this trend this time around. That wraps up our economic and market update for today. If you would like more information on anything discussed in this video or on legacy private trusts in general, please don't hesitate to reach out to PJ or myself. Our information is on our company website, and you can also contact marketing at lptrust.com. Thank you for watching, and have a great rest of your day.